In this video, you're going to see how to compute the income from other sources for the assessment year 2020-21 of Mr. Jitendra, whose investment has been given on 1st April 2019. So he has made 8 investments. So out of this 8 investment number 5, that is 7% national plan certificates of rupees 10,000. This will be exempted from tax. Then also the dividend received on the unit trust of India, this is also exempted from tax. The rest will be taxable. And we also have the bank commission for collecting interest, which is rupees 100. So the bank commission for collecting interest will be allowed as deduction from the total interest which has been received by the assessee. And another thing they have given here is that the interest on securities payable twice in a year, that is on 1st January and on 1st July of the current previous year. So now let us look at the solution. So the first one is the interest on 10% UP government loan, which has been calculated for 1 year. That will be rupees 3,000 because the amount of loan is rupees 30,000 and the rate of interest is 10%. So 10% of rupees 30,000 will give you 3,000. Then the second one is rupees 10,000, 10% debentures of a jute mill company. So remember, for debenture of a company, there will be a tax deduction at source at 10%, okay, at 10% per annum. But in this case, since the face value of investment has been given and the rate of interest has been given, so the gross amount of interest for this particular investment will be 10% of rupees 10,000, which will be rupees 1,000. So it's not needed to gross up because the amount itself which has been calculated is the gross amount. Then the interest on the debenture of a cooperative society which has been given for rupees 2,000. So this will be the gross amount because there's no tax deduction at source for debenture of a cooperative society. Then we also have the interest on foreign government security. So he has invested in foreign government security for rupees 15,000 and the rate of interest is 6%. So 6% of rupees 15,000 will give you rupees 900. But for foreign government security, there will be no TDS. So whatever amount has been calculated, that will be the gross amount. Then the interest on national plan certificate, that is exempted from tax. Then dividend from unit trust of India, that is exempted from tax. Then interest received on less tax government security. Okay, that is for point number 7. This will be the gross amount, so no need to gross up because whatever amount has been received, that will be the gross amount has been given in the problem itself. Then the interest on tax-free listed debentures. Now in the case of tax-free listed debentures, the interest on tax-free commercial securities is always gross up whether its rate percent is given or the amount received is given. So this you have to note it down as the note has been given in the last part of the slide, which says that interest on tax-free government securities always grows up whether its rate percent is given or the amount received is given. So the interest as per the problem has been given at rupees 5,400. So this has to be grossed up since it is a tax-free listed security where the TDS is 10%. Now if you have to gross it up, the gross amount will be 5,400 and into 100 divided by 90. So the gross amount of interest on tax-free listed debenture will be rupees 6,000. So if we add it up, the total amount of of the interest which has been received will be 16,500, and we'll less the bank commission for collecting interest, that is rupees 100. So we'll get income from other sources for rupees 16,400. Now if you look at the next slide, you'll see how to gross up the interest on security. So the gross amount will be the net interest received into 100, then divided by 100 minus the rate of tax.